Hey everybody, welcome back. We're about to talk about investment spending. Now I want to give a little context to this video. We're in Unit 3, and the main thing we're doing in Unit 3 is we're building out the ASAD model, okay? A model of aggregate supply and aggregate demand. All we've done so far in this unit is look at consumption, one component of aggregate demand. There's actually going to be 4 components of aggregate demand. There's going to be consumption, investment, that's what this video is about, government purchases, and net exports. But like I said, this video is about investment. It's the second component of aggregate demand, okay? This is the demand of businesses in our economy. Now I want to talk about this word investment just for a second because it does cause some problems in economics. You see, if we haven't taken an economics class and we hear the word investment, we generally think of the buying of stocks and bonds. Well, that is true. That is a type of investment, but that type of investment is what is known as portfolio investment. Economists actually oftentimes call that type of investment simply household savings. So if you hear household savings, hey, think of that as portfolio investment, which would include things like buying stocks and bonds and other types of households trying to invest their money. But when we say investment in economics, we're talking about business spending on their business, okay? Investment is actually a short word for the word business investment. So anytime we hear investment, think business investment. And if you think business investment, what is that? That is a business spending money on its business, okay? Spending money on goods and services, real capital, for their business. And what we mean by that is spending money on machines, equipment, computers, software, any spending on real capital for their business. But here's the big thing. Remember, investment to an economist is a type of spending money, okay? Now, what I've got here for our first video on investment is a list of projects. Project A, B, C, D, and E. But I want you to imagine that this is a business, a single business right now, just looking at some potential projects that they can do. And I want you to think of these as very different projects. Hey, we could do this one project, which is for this one plant. We're going to update the equipment. Here's another project. Here's actually we're going to build a new plant somewhere. Just think of this as different projects that a single business is looking at. What I've written in this column right here is how much they would have to spend to do the project. Now I want to put a little caution on this column. Oftentimes we want to say, hey, this is how much it costs to do the project. Well, that's not really true because this is just one of the types of costs to do the project, okay? This is a type of explicit cost to do the project. So I don't want to use the word cost, okay, because cost is bigger than just this column. Remember, cost is opportunity cost. An opportunity cost looks at both explicit and implicit cost. So all I'm saying that this column is how much we'll have to spend to do the project. And then I've got these next 2 columns that I want to fill out with you, okay? This is the expected revenues, and this is the expected real rate of return, okay? Now, for this particular column, I'm just going to make up some numbers for us to kind of play with a little bit here, okay? Let's say for project A, I'd have to spend $10 million, and let's say my expected revenues for this particular project is $11 million, okay? For project B, I'd have to spend $20 million, and my expected revenues for this one, we're going to say is $21 million. Here's project C, have to spend $5 million. Our expected revenues, we're going to say is $6 million. Once again, I'm just making these up. No calculation is happening right now. For project D, spend $20 million, and it's going to provide for $22 million in expected revenue. In project E, I've got to spend $10 million. We're going to say $12 million in expected revenues. Now, before I go any further, I want to talk about this little parentheses under these 2 columns. It says today's dollars and today's dollars. You see, we're going to spend this money kind of in the near term, okay? You could even think of like spending it now, but we're not going to make revenues till the future. So that's a problem, okay? We've got dollar amounts at different points in time, and since the dollar changes value over time, that can create problems. So I'm trying to make sure that we don't have that problem by saying, hey, I've done this column in today's dollars, and I've also done this column in today's dollars. So in a way, you could think of this as these are real numbers, okay? And real numbers in economics we can compare across time, okay? So the value of the dollars used for this calculation and the value of the dollar used for this calculation is the same. So hey, we can make comparisons. And that's also why this column says expected real rate of return, okay? Because I've got this in basically the same base year, and that base year is being today, okay? Being right now is our base year. So we've got all these dollar values based on today's prices. With that said, I want to jump to this last column, this expected real rate of return column. So now I've got to do a calculation, okay? I'm basically asking, what is my expected real rate of return of that $10 million for project A? Well, since my revenues are going to be $11 million, I'm going to take my revenues minus how much I have to spend, $10 million, okay? So that gives me $1 million. But then I'm going to divide that by 10 million. Why am I dividing it by 10 million? Because what I'm going to put here is going to be my expected real rate of return on the money I'm going to spend, that 10 million. So once again, the difference between 11 and 10 is 1 million divided by my original spending, which is 10 million. 1 over 10 is 10%, okay? Is 10%. For this next project, project B, I've got 1 million difference over how much I'm going to have to spend, 20 million. So my expected real rate of return is going to be 5%. 5%. For project C, my 1 million is the difference between my expected revenues and how much I have to spend, divided by how much I have to spend, because once again, I'm finding the expected real rate of return on the $5 million. That's why I'm taking the difference, 1 million, and dividing it by 5 million. And I get 20%. And then for project D here, 22 million, 20 million, the difference being 2 million divided by 20, 2 divided by 20, 10%. Once again, expected real rate of return on that $20 million of spending. And then E, the difference, 2 million divided by 10, 2 divided by 10, 20%. And there we have it. Those are our expected real rates of return. Now I want to caution you, sometimes we want to call these profits, okay? And they are profits to an accountant, but they're not profits to an economist. Before I can actually get to my profit, I'm going to have to subtract off from these expected real rates of return something very important, the interest rate. And once I take these expected real rates of return and I subtract off the interest rate, another cost of doing an investment project, then I'll actually have my profitability of these projects, okay? At this point in time, it looks like they're all profitable, but actually, like I said, those aren't profits. It really depends on the interest rate on whether or not they are profitable. And that's what we're going to do in the next video, okay? We're going to take this column right here, this expected real rate of return. We're going to compare it to the interest rate to see just which one of those projects are profitable and which ones we're going to do. All right, hope that helped. We'll see you in the next video.